Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of all the corporate jargon so you do not have to. Today we are diving deep into the financial report from Academy Veteran Bond ETF. Think of it as a yearly checkup for this investment fund, showing us all their financial health and what they have been up to. Before we dive in, if you appreciate getting these no-nonsense breakdowns of financial reports, make sure you are subscribed. We also have a Discord community linked in the description below where we discuss these filings in more detail. Alright, so what is this report all about? Essentially, it is a look at the Academy Veteran Bond ETF, also known as VETS, for the period ending the 31st of July 2025. It tells us how well it performed, how much it cost to invest in, and where the money was actually put. It is a blend of performance numbers and a look under the hood at their investments. Let us get straight to the money side of things because that is what most people care about. For a hypothetical $10,000 investment over the past year, the cost associated with holding this fund came in at $36. That is a mere 0.35% of the investment. This is a pretty small chunk and indicates that the fund is not bleeding money through fees. It is important to remember that this is just the cost of investing, not the gains or losses you might have made. Now let us talk performance. The table here shows us how a $10,000 investment would have grown over time when invested in the Academy Veteran Bond ETF compared to two major market indexes, the Bloomberg US Aggregate Bond Index and the Bloomberg US Mortgage Backed Securities Index. Just looking at the end date, the 31st of July 2025, our imaginary $10,000 investment in the ETF grew to $10,979. That is a gain of about 9.79%. The Bloomberg US Aggregate Bond Index saw a similar $10,927 return, while the Mortgage Backed Securities Index finished at $10,914. So the ETF slightly outperformed both indexes over this period. Interestingly, looking back to the 1st of August 2023, the fund has shown a consistent upward trend. For instance, by December 2024, a $10,000 investment would have been worth over $10,500, growing to over $10,900 by July 2025. This shows a healthy growth trajectory. Let us look at a more summarized version of performance. For the one-year period ending the 31st of July 2025, the Academy Veteran Bond ETF returned 4.03%. That is higher than the Bloomberg US Aggregate Bond Index, which returned 3.38%, and the Bloomberg US Mortgage Backed Securities Index, which returned 3.36%. Since inception on the 1st of August 2023, the fund has an annualized return of 4.78%, beating both indexes as well. This indicates that the fund has been successfully navigating the market and delivering value to its investors. So how did the fund achieve these results? The report states it is an actively managed exchange-traded fund focusing on high-quality mortgage, backed securities and asset. Backed securities, the strategy aims for broad diversification with minimal corporate credit risk. They use loan-level analysis and quantitative modeling to beat the Bloomberg US Mortgage Backed Securities Index. For the fiscal year ending the 31st of July 2025, the fund returned 4.03% net of fees, which is indeed higher than the 3.36% of the mortgage. This shows their strategy is working. What really moved the needle for this fund? The report points to active security selection in the agency mortgage, backed and asset-backed securities markets. Basically, they picked specific investments that did well. Lower coupon bonds were particularly strong performers. Interest rate volatility was a big factor. The Federal Reserve lowered its policy rate by a total of 100 basis points, while the 10-year US Treasury yield went up from 4.03% to 4.37%. This rise in yields typically hurts bond prices, but the fund's careful selection of securities helped to mitigate this. Also, spreads on mortgage, backed and asset-backed securities tightened, which is good for performers. Mortgage rates remained stable at around 6.72%, which kept refinancing low, but housing activity was also subdued due to high rates. Looking at the specific holdings that helped the fund perform well, we see a list of Ginnie Mae the Sukin pools. For example, Ginnie Mae the Sukin pool CNO347 with a coupon of 3.00% and a maturity of 2052 was a top contributor. These are mortgage-backed securities guaranteed by the US government. These types of securities are generally considered very safe. On the flip side, certain Ginnie Mae II pools also detracted from performance. For instance, Ginnie Mae II pool BS 8912 with a 3.00% coupon and a 2050 maturity was listed as a detractor. This just shows that not every investment works out perfectly, but the overall contribution of the good ones outweighed the negative ones. An interesting aspect of this fund is its social impact. It aims to support active duty service members and veterans. As of the fiscal year end, they held 1084 veteran loans, resulting in a significant $6.2 million in savings for these individuals. This is a nice touch that goes beyond pure financial returns. Let us look at some of the fund's key statistics as of the 31st of July 2025. The total fund size was about $79.4 million. It held 111 different investments. The total advisory fee paid was around $260,000, which aligns with the cost we saw earlier. The portfolio turnover rate was 18%. This means they bought and sold about 18% of their holdings during the year, which is a moderate level of activity suggesting they are not constantly trading in and out of positions. Where was the money actually invested? The sector breakdown shows 81.8% in mortgage, backed securities and 15.7% in asset. Backed securities, only a small 2.5% was kept in cash and cash equivalents. This confirms their focus on MBS and ABS as mentioned earlier. The top issuers, unsurprisingly, are dominated by Ginnie Mae II pools, making up a massive 80.9% of the net assets. Small business administration pools followed at 15.7%. This heavy concentration in government guaranteed or supported securities highlights the fund's strategy of seeking safety along with income. And what specific investments did they hold? The schedule of investments is quite detailed, for example under mortgage. Backed securities, we see a lot of Ginnie Mae I and Ginnie Mae II pools with various coupon rates and maturity dates. One of the largest holdings is Ginnie Mae II pool, 786,134 with a 3.00% coupon maturing in 2052 valued at over $2.3 million. They also hold numerous small business administration pools, for example Pool 530887 with a 6.50% coupon maturing in 2035 valued at over $2.2 million. This deep dive into specific holdings really shows their strategy at play. Looking at the statement of operations for the year ended the 31st of July 2025, we see that the fund generated $4.9 million in investment income, mainly from interest. The total expenses were around $260,000, which is the advisory fee. This resulted in a net investment income of about $4.6 million. There was a net realized and unrealized loss of about $1.7 million from investments. Overall, the net increase in net assets from operations was around $2.9 million. The statements of changes in net assets show that for the year ended the 31st of July 2025, the fund had an increase in net assets of just over $5.7 million. This is a combination of net investment income, capital gains and losses, and capital transactions. The fund also paid out about $4.6 million in distributions to shareholders, reflecting its income generation focus. The financial highlights per share give us a clear picture of profitability. For the year ended the 31st of July 2025, the total return per share was 4.03%. This is calculated after accounting for income gains and losses. The ratio of expenses to average net assets was a consistent 0.35%. So the costs to manage the fund remain quite stable year over year. Now for a brief look at the notes to the financial statements, which are important for understanding the details. They mention that the fund is part of Tidal Trust I and is managed by Tidal Investments LLC. They also explain how securities are valued, which is crucial in the financial world. For example, mortgage-backed securities are valued using an evaluated mean of bid and ask prices from independent pricing agents. This is a standard practice to get fair market values. No financial report is complete without discussing risks, and this one is no different. They highlight risks related to agency small business loans and mortgage-backed securities. There is also issuer credit risk, meaning the risk that a company issuing a bond might not be able to pay back its debt. Importantly, they point out exchange-traded fund or ETF risks. This includes concentration risk with authorized participants, which can affect liquidity, and cash redemption risk if the fund cannot redeem shares in kind easily. There is also general market risk, interest rate risk, and management risk. This section is a good reminder that investing always carries some level of risk. Finally, we have the report of independent registered public accounting firm. This is basically an auditor's stamp of approval. Cohen and Company Ltd LLP states that in their opinion the financial statements present fairly the financial position of the fund. This adds a layer of credibility to the reported numbers. So what is my take on all of this? Academy Veteran Bond ETF seems to be running a solid operation. They are consistently outperforming their benchmarks and providing value to investors. Their focus on high-quality government-backed securities offers a degree of safety, which is attractive in uncertain economic times. The social impact aspect is also a positive differentiator. The costs are low and the performance is strong. The risks mentioned are standard for this type of fund and are well managed. Overall, this filing paints a picture of a well-managed fund that is delivering on its promises. It is a good option for investors looking for income and stability in their portfolio with a slight tilt towards supporting veterans. Alright, that is our breakdown of Academy Veteran Bond ETF's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.